Hi everyone, Piers Bolger here, the Chief Investment Officer at Viridian. Well, we're through March, which saw obviously a very significant decline in equity markets and a really challenging period for investors, just given the ongoing spread of the coronavirus and just the response that we've seen to date, which has resulted really in significant lockdowns in every country around the world, and that's clearly had a big impact on financial markets. And we thought, just in terms of the discussions we've been having with clients, was well, is there any light at the end of the tunnel, and do we think that there is some opportunities in what has been a really difficult market environment? And we thought we'd share just a couple of points to note around that, and just give you some of our perspectives on our view that we certainly do believe that there is light at the end of the tunnel. It may be still a little while away, but it doesn't necessarily mean that investors should be completely forgoing the opportunity that is presented when you do see such a significant fall in equity markets particularly. The first slide here just gives you a bit of a snapshot on China, and you can see here in this chart, this just reflects the manufacturing side of the Chinese economy, both in terms of both services as well as industrial activity, so the composite index there. You can see there through February that sharp decline. In fact, it was the largest single-month decline ever seen in terms of the Chinese economy. And prior to that, obviously, the PMI indices looked relatively stable, as you can see there. The important point to note, above 50 means that the economy is expanding, and below that, a contractionary aspect associated with the economy. And you can see clearly in February that moved into a big negative in terms of the contractionary phase, and that was to be expected when you think about the extent of the lockdown, and obviously Wuhan being a significant industrial centre for China. Through March, though, we saw a big rebound as China got on top of the coronavirus. We started to see stabilisation rates and the rate of spread actually decline. China was able to reopen up its economy, and now we're probably looking at China sort of somewhere in the sort of 80% range, we would say, in terms of sort of where they were prior to locking down the economy and prior to the spread of the virus. But notwithstanding that, we have seen obviously a significant decline globally. So when you compare sort of that chart there, which does see that snapback, when you compare that to the second chart, China being really the export engine of the world in terms of manufacturing, you can see there that notwithstanding the uptick that we've seen domestically, clearly export markets remain relatively constrained. And you can see in the context of a similar chart there around sort of just looking at the export side of the Chinese economy, it's still in contractionary phase. So there's still a lot of excess capacity that's still there in China in our view, and will be continuing to be there for an extended period as the rest of the world really needs to play catch up in order for, as I said, that growth to start to kick in. So what does that then mean if you're an investor? And does that then mean that you run to the hills and you forgo the opportunities we said earlier around taking advantage of depressed market prices across certain sectors and obviously individual companies? I mean, in our view, that's not the case. We've always taken the view that you should be thinking about not only what's occurring here and now, but equally thinking about the opportunities that you can create from the falls that we've seen in equity markets. Clearly, we think that what we're seeing at the moment is going to continue for some time. So one of the approaches that we've been taking in terms of that has been averaging into our position. So rather than investing everything we've got now, as I said, is we've been moderating our approach to investing into either new positions or adding to existing positions where we've got a high conviction in. And I just thought I'd share with you just a couple of those companies, both for our large cap Aussie equity portfolio as well as our small to mid cap portfolio. If you look at this slide here, this is just a reflection of our large cap portfolio. And in looking at this slide, there's probably a couple of names I just wanted to bring out to your attention where we believe that there is certainly opportunity, not only now, but more importantly going into the future. And the first one of those is BHP, as we know, largest materials company, mining company in the world. But when we think about BHP, clearly it's a commodity-driven company. Its main production is iron ore, and that's obviously used in making steel. So when you think about the importance of steel in the context of global economic growth and economic activity, it's one of our biggest buyers of that iron ore is China. So again, when we're positioning our portfolios, we're not only thinking about that side of it. But as we expect and as we continue to believe that the demand for iron ore will increase as we move through this phase, particularly as we think about the ongoing growth that we're expected to see on the back of this, we think that BHP will be a natural beneficiary of that through its iron ore. But more importantly, BHP also mines another couple of important minerals. It mines copper, which is used not only in industrial production, clearly industrial production is lower, but equally just the importance of that in regards to electric vehicles as an example, and just the way that we believe, certainly through the context of the evolution of what we're going to see on the industrial landscape, the copper is going to become an increasingly important metal going forward. Sitting alongside, obviously, the energy side of their portfolio as well. So again, when we think about the context of BHP, we think there's significant upside from that business as the recovery takes hold. And as I said, we don't believe that we're seeing prices, whether it be for iron ore, oil and the like, are going to continually be as depressed as where they are today. So BHP as a theme for us is not only the diversified nature of it, it's also a long-term theme in terms of what can be delivered on the upside. Another one there is CSL. So again, healthcare is a theme that we've been significantly overweight for a number of years now. Effectively, we really like the thematic around healthcare, and Australia's been blessed to have really a number of leading healthcare companies, and CSL being clearly one of them. CSL dealing into obviously blood plasma, but equally in the development of vaccines and other drugs related to the healthcare industry, and just the way that they're able to execute on that, and particularly in the environment that we're in, we believe CSL is going to continue to deliver that growth. It's got a very significant global footprint which continues to grow, and we believe, as I said, is a market leader in its field. So not only is that a stock for today in terms of dealing as a defensive nature within a portfolio, we believe there is certainly significant growth as well in CSL going forward. And the other business there is Goodman Group. So Goodman really plays into our IT, into our e-commerce theme. So, certainly coming out of this, we think that the retail landscape is going to change materially. We think the way individuals shop is going to change materially, and we certainly believe, as I said, that Goodman's going to be a natural beneficiary of that, particularly in terms of their big box, in terms of their industrial warehousing for distribution centres built around e-commerce as an example. So we think Goodman can really take that growth that they've had in more recent times and continue on with that going forward. As I said, even as a defensive positioning today, from a REIT point of view, we believe that Goodman is really well positioned. On the other side of that chart, you can see there is our sectoral positions, and you can clearly see the divergence between healthcare when we're thinking about stocks and companies such as CSL and ResMed, as well as obviously our financials position, and we're underweight financials, and we've continued to be underweight principally in the retail banks. As many of you would know, that we feel that the retail banks are looking challenged in their outlook for earnings growth over the medium term. Doesn't mean we don't have exposure to them in order to protect that downside, but we certainly don't see the growth in that part of the market as significant as what we can see in other sectors, whether it be in materials, broad-based industrials, healthcare and IT, for example. So, as I said, we've been moderating our position there, where we do like our exposure to financials in companies such as Magellan Group, which we again will believe is going to be very linked to the upswing in equity markets through time. We think it's a really good business. It not only has a very strong capability in global equities, but also in other asset classes, whether it be infrastructure and Australian equities to a lesser extent. So the growth optionality with a group like Magellan Group, and also with Macquarie Group in terms of financials, we believe is greater than traditional retail banks. We then move to our small to mid-cap portfolio, and again, those themes start to play through as well. And probably the biggest theme that you can see in that portfolio is our position in IT. And again, the IT side of our portfolios is really built around the thematic that we believe service as a software as a service, or SaaS as it's known, is going to continue to grow in importance. And just the way that we're interacting at the moment in regards to the delivery of our videos, as an example, is that a lot more is going to happen outside the office going forward, and we think that that's a theme that, as I said, a lot of Australian companies have been able to deliver on. So if you just look at a position there in NextDC, so NextDC, just think about that as an infrastructure play for data. So it provides boxes effectively for companies to be able to store data, store computing, which enables them to be able to store data within that in a secure environment. And so cloud computing and the like is a really important component part, and their ability to be able to do that for businesses and be able to provide the connectivity for businesses around data warehousing is fantastic. And we think as a business, as I said, it's going to be a big winner out of the changes to the way not only businesses but consumers think about operating going forward. Another business there that we have in that portfolio is Tyro. So Tyro is a financial payments business. It sort of sits somewhere between financials and IT in our view, but if you just think about when you go and pay for your coffee, if you can still get one at the moment, but if you go and pay for your coffee, you'll tap with your card, and there's a very good chance that the cafe or the restaurant that you're doing uses Tyro payment facilities. It's an EPOP facility. Again, we believe it's a really high-quality growth business. Clearly, we're seeing, obviously, a slowdown in discretionary spend at the moment. But when we think about that business and we think about the opportunity for that business, particularly because it owns its own software and the development that sits within that, we believe there is significant opportunity for a business like Tyro. So when we look at that from a context of overall portfolios, we think that there is not only businesses today that can manage through, obviously, the challenges that we're seeing in regards to financial markets environments, but there are certainly businesses that we're continuing to add to that we believe will not only take advantage of what's occurring today, but equally and more importantly, are well positioned for growth. So hopefully this gives you a quick snapshot on our thoughts on portfolios. As I said, market conditions are difficult, but it doesn't mean from an investor's point of view that you don't take some of those opportunities that are presented in difficult market environments, as I said, to really double down on your higher conviction plays, but equally think about how you can then build portfolios for the future. And that's exactly what we're doing here at Viridian. As always, if you have any concerns, please feel free to reach out to your advisors, and we look forward to, as I said, touching base soon. Thanks, and bye for now.